Hello and welcome. I hope you're doing well from wherever it is you're joining us. This is a course about central banks, monetary policy and the macroeconomy. We will discuss how monetary policy is implemented and how choices made by the central bank are eventually transmitted to the macroeconomy. You will gain a deep appreciation of the goals of monetary policy. We are going to start with the nuts and bolts of monetary policy implementation. You may have heard statements from the central bank such as, "We are raising the interest rate by 25 basis points," or "We are expanding our asset purchase program to put downwards pressure on long-term interest rates." But what does it actually involve in practice? How does the central bank implement this policy? Which interest rates are affected and why? Monetary policy implementation is a complex topic that involves several different financial markets and financial instruments. This module provides the necessary background and explains exactly which interest rates are targeted by monetary policy. A word of warning: since monetary policy is only discussed in the next module, the videos in this module may feel a little disjointed and you may wonder how these videos relate to each other. So let me give you an overview how the videos in this module fit into the bigger picture. The first two videos introduce two short-term funding markets, the market for federal funds and the repo market. These are important short-term funding markets. We sometimes call them cash markets or money markets. This is where financial institutions come to borrow and lend. These are overnight money markets and are the main targets of monetary policy. You may already know that the Federal Reserve targets the interest rate in the federal funds markets, the federal funds rate, by announcing a target range for this interest rate. The repo market is an alternative to the federal funds market. Hence, the Federal Reserve also targets the interest rate in the repo market to ensure that all overnight interest rates are consistent with monetary policy goals. The next video compares another overnight interest rate, the London Interbank Offer Rate, with the repo market interest rate, as these interest rates are the benchmark for loans to firms. We then examine three key financial instruments that are central to the implementation and transmission of monetary policy. First, we'll look at government securities. Central banks buy and sell government securities to implement monetary policy, so understanding what they are and how they work is crucial. Since the US government securities have no default risk, we can also look at the components of the interest rates. For instance, how much of the interest rate reflects inflation. Since interest rates capture inflation and expectations about the future, we can compare the interest rates on shorter and longer maturity government securities to help us understand market expectations of future economic developments. We call this the term structure of interest rates. The term structure of interest rates is closely watched by central banks, investment banks, and financial analysts because it reflects the market expectations about the future developments of the economy. We then consider money market mutual funds. Money funds are the largest overnight lenders of cash in the repo market. After the 2008 financial crisis, the Federal Reserve has started to conduct monetary policy with these funds, as you will see later in this course. Finally, we consider securitization. Securitization has increased credit supply. Pools of securitized mortgages, also known as mortgage-backed securities or MBS, are especially important, since monetary policy affects the economy by reducing or increasing the supply of credit, and the Federal Reserve can purchase certain MBS. Securitization markets are an important factor in monetary policy considerations. In sum, all of the markets and instruments discussed in this first module are directly related to monetary policy and its implementation. Each video provides a small piece of the larger picture that will become clearer in the next module. Please try not to get frustrated if you have a hard time placing each video in the bigger picture. Keep in mind that these videos provide the background for understanding monetary policy and its implementation. You can always come back to these videos later, when we discuss specific monetary policy tools that targets the markets or instruments, or when we discuss financial crises if you need to refresh your understanding of a particular concept.